Hi, so this is part 2 for accounting for share capital. So in previous lecture we have discussed about what is meant by share and what is meant by share capital and what are the types of shares, equity shares, preference shares and types of share capital, and then you can issue shares at par, premium, discount, right? We have discussed that. And then par means equal to the face value, premium means more than the face value, discount means less than the face value, right? Okay, so now we need to do accounting for that. So what is the general entries you pass when they issue shares at a par, that means equal to the face value? Your bank balance is increasing. Okay, let me tell you the general entries first. You can see the first video, or you can, if you don't know how to pass a general entries, you just have to learn this. Asset and liabilities. Asset and liabilities normally shows debit balance. If you want to increase the assets, then you need to debit it. If you want to decrease the asset, you need to credit it. The liability normally shows credit balance. If you want to decrease the liability, if you want to increase the liability, credit it. Decrease the liability, debit it. Right? Yeah. So now expenses always shows debit balance. Income always shows credit balance. I hope you know all those things. You might be learned this in 11th or 12th. And capital is a liability. You will write in the balance sheet liability side. You know why? Because due to business entity concept. Business entity concept. According to this concept, owner is separate and business is separate. Owner contribute to the capital to the business, so now business is liable to pay back to the owner. So that's why for business, capital is a liability. So since you might have already learned all these things, so I'm going pretty much fast. Yeah. So now shares can be issued at par, premium, discount, and the discount we don't need to worry. We don't need to pass any general entries for the discount, because as per section 53, no company can issue shares at discount. So let's pass a general entries if the shares are issued at par equal to the face value. You can receive the money in lump sum or installments, right? So if you receive the money in lump sum, these are the general entries. First, when you receive the money, you will pass bank account debit to share application account. Your bank balance is increasing, that means asset is increasing, so that's why you have debited it to share application account. After receiving the money, you need to transfer the share application money to share capital account, because our ultimate goal is transfer the money to the share capital account only. If you observe, share application debit cancel and then share application credit cancel. Now ultimate entry is bank account debit to share application share capital account, right? So in the balance sheet, bank is what? Asset. Bank account, let's just say you are receiving 10 rupees, and then capital, share capital will also be 10 rupees. Both are equal. So this is our main objective, right? So these are the general entries: bank account debit to share application account, and then share application account debit to share capital account. Now when you receive the money in installments, so there are different installments when you can receive the money. First is share application account. This is first installment. If anybody is interested in the company, then those people has to pay the first share application money. Then you will allot them, that is share allotment account. While allotting the money, while allotting the shares also, you will collect some money, share allotment. Then first call, second call, third call, final call, so on, right? So you can collect the money in installments also. At every stage you need to pass a general entries. Whenever you receive the money from any installments, you need to pass a general entries. Okay, so let's, for the on receipt of application money, let's pass a general entries for this. First, you are receiving the money. So the same entry, bank account debit to share application account, because your bank balance is increasing and you are transferring that money to the share application account. And then ultimately you need to transfer this share application to where share application account debit to share capital account, like in here same. Okay, the only difference between that and this is, here if your face value is 10 rupees, you are receiving all 10 rupees at one shot. Here you might be receiving only 2 rupees for the first installment, right? Okay, now if there are so many reasons to reject the application, which we will discuss later. Let's just say you rejected the application money, then you need to return the money to the public. Then all you need to do is reverse this general entry, right? So previously you wrote, when you receive the money, you wrote bank account debit to share application account. Now you're refunding, so share application account debit to bank account. Then next entry, allotment money becoming due and received. Second installment, so allotment money. First you need to pass a due entry. So you will pass the share allotment account debit to share capital account, right? When you receive the money, you will write bank account debit to share allotment account. So first you will write share allotment account debit to share capital account. It's a due entry. When you receive the money from them, then you will write bank account debit to share allotment account. Now see here also, ultimate entry will be the bank account debit to share capital account. This one will get cancelled. Debit and credit will get cancelled. Ultimate account entry is this. Now this is for the allotment. Now next installment is first call. For the first call also same, right? So first one is share first call account. This is the due entry. Share first call account debit to share capital account. And then when you receive the money, bank account debit to share first call account. Here also this one and this one will get cancelled. Ultimate entry will be that. So whatever it is, ultimately you will receive the money in bank and it will be transferred to the share capital, right? Let's see the second call. In the second call, due entry is made. Again, share second call account debit to share capital account. And when you receive the money, bank account debit to share second call. So here share second call and share second call will get cancelled. The money will be transferred to the ultimately to the share capital account. And the same goes for the final call. Share final call account debit to share capital account is the due entry, and then when you receive the money, bank account debit to share final call account. So credit debit will get cancelled. Ultimately this money will be transferred to the, so whatever the installment it is, ultimately money should go to bank account debit to share capital account. That is the ultimate entry, right? Okay, so far we have discussed the general entries. So what you have seen, when the application money is due, share application account debit to share capital account. When you receive, bank account debit to share application account. When the allotment money is due, share allotment account debit to share capital account. When you receive, bank account debit to share allotment. Same goes for all, right? Okay, So that's it. These are the issue when you issue shares at par. These are the general entries you will pass. When you issue shares at premium, what does it mean? When the share value is 10 rupees, you are issuing the shares at 12 rupees, right? Then you are issuing shares at 2 rupees premium. This 2 rupees you will consider it as a capital receipt because this is non-recurring nature. You are not receiving this daily, right? So this is a capital receipt. You will transfer these 2 rupees to a separate account called as securities premium account. Securities premium account. There is no restrictions for issuing the shares at a premium. If your share face value is 10 rupees, you can issue even for 1000 rupees also. There is no restrictions on that. But when you collect this premium, how to use that premium? You can use that securities premium only for the specific purpose specified by the Companies Act. Only for that you can use this. Alright. Okay, this securities premium account has shown under the liability side under reserves and surplus. Okay, now you can use that share securities premium only for the specific purpose. So these are the specific purpose given by the Companies Act. You cannot use this securities premium for any purpose other than the specified. So you can use this securities premium to issue the fully paid bonus shares or to writing of the preliminary expenses. While incorporating your company, if you incur any expenses, that will be called as preliminary expenses. You can use that to write off that expenses. To write off the expenses or commission paid or discount allowed of an issue of shares or debenture of the company. While issuing the shares, if you incur any expenses, that is also then also you can use this money to write off that. Right? Now, in providing the premium payable on redemption of any redeemable preference shares of any debentures of the company, you can use this money for redemption of premium, right? So what does it mean? Let's just say you have taken 10 rupees from the public and you issued preference shares to them, right? Now while redeeming, you are redeeming at 12 rupees. That means you have taken 10 rupees only, but you are paying 12 rupees back to them. That means 2 rupees is a loss for you, that right? And then these 2 rupees loss you are covering with this securities premium account. So you are writing off this with the help of securities premium account. In providing for the premium payable on the redemption of any redeemable, while redeeming, if you pay any premium, that will be written off by the securities premium account for the purchase of its own shares or other securities. That means nothing but buyback. So you can issue the securities premium for buyback, for bonus, and to write off the preliminary expenses. And then next one is, if you incur any expenses while issuing the shares, like commission paid or discount allowed, that can be written off by the securities premium account. And you can, while redeeming the preference shares or debentures, if you redeem that with the premium, that can be covered by the securities premium account. Okay, next one, minimum subscription. So when you issue the shares to the public, in the prospectus there will be mentioned minimum subscription. Let's just say they said 90% is the minimum subscription, right? Then you have to, if you issue 100 shares, right, then 90 shares should be subscribed. Otherwise then that will be called as, just a minute, sorry, otherwise it will be called as under subscription. under subscription. If public subscribed less than the minimum subscription, that is called under subscribed. Let's just say your company is very good, they subscribe for 120, right? Then that is over subscription. If they subscribe 90, right? If they subscribe less than 90, that will be under subscription. If they subscribed more than 90 or more than 100, then it will be called as over subscription. Over subscription. Sorry. So the minimum subscription will be given in the prospectus. If they mention 90%, then 90% should subscribe. If they subscribe any less than 90, then that will be called as under subscription. Let's just say you have issued only for 100, but 120 people subscribe your IPO, then that will be called as over subscription, right? So first we will discuss what happens if your issue that didn't meet even minimum subscription, like 90 people you said, but they subscribed only 80. Then your entire IPO will get cancelled, or your entire issue will get cancelled. Then this 80 people, they already gave share application money to you, right? You need to refund them. So when you have taken the money, what is the general entry you might have passed? You might have passed bank account debit to share application account. While refunding, you just reverse that share application account debit to bank account, right? So if there is under subscription, if it is met the minimum subscription, then fine. If it didn't even meet the minimum subscription, then you have to cancel the entire issue and refund the money, right? If it met the under subscription, then we don't need to worry about that. And what happens if there is a over subscription, right? That will be discussed in the next class.